Good morning, Tabuko, Bushe Alan. How many members are in the platform?
Morning, Chairperson. We currently have 5 members on the platform.
Only 5. Myself, Honorable Bateman, Honorable Beasley, Honorable Lekhanyane, Honorable Khade, and okay.
Good morning, Chair. Mr. Van Rooyen just phoned. He's about to join the meeting. Thank you.
Okay, thanks. I see Honorable Van Rooyen has joined. Are we 6 now?
Yes, Chairperson.
Okay. Please flight the agenda. Okay. The meeting is officially opened. All members who are in attendance, they are welcome, and welcome our support team of SCOF, welcome National Treasury, SARS, media, and all other interested stakeholders who are in the platform and other staff members of Parliament. The purpose of the meeting is to get a briefing by National Treasury and SARS on the draft tax bills. Do we have apologies?
Chair, morning. Apologies received from Miss Alexander, Dr. Burke, and I think that's it from my side, Chair. Thank you.
Okay. Those are the apologies. Let's record them. Then let's move to the next item, item 3. Briefing by the National Treasury and SARS on the draft taxation bills. Over to you, National Treasury and SARS.
Thank you very much, Honourable Chair. Good morning, Honourable Members. I'll take you through some of the slides, and then we have quite a few colleagues of mine who can talk to a lot of the technical issues in the slides. I hope all the members have got a copy of the slide deck. I'm sure Chancellor will start to share the slides, but as he does, Honourable Members, this is to try and brief you on 3 of the tax bills that we put forward. They are all in draft form, so they haven't been tabled, but we do like to have these briefings to let you know what's in them so that we can have further consultations both with you and with the public before we do table these bills. Given they are quite technical, it's useful for us to get those comments, make suggested changes before tabling. Those bills are the Draft Rates and Monetary Amounts and Amendment to Revenue Laws Bill, the Taxation Laws Amendment Bill, and the Tax Administration Laws Amendment Bill. In the Draft Rates and Monetary Amounts Bill, which we call the Rates Bill, we include a lot of the measures that were announced at the time of the budget. That includes, for example, the changes to excise duties on alcohol and tobacco. It includes amendments to the employment tax incentive. It includes a couple of others. When Ntlanhla brings the slides up, if you can bring those up when you can, Ntlanhla, it would be useful. Then you can see those different measures. The draft rates bill, because this was a different process, we did actually table that bill earlier. That was the bill that originally had the VAT increase in draft form, and then when we made the new budget in May, we took out that adjustment. We didn't then make any changes to the personal income tax brackets, and we did have an inflationary increase in the fuel levy. The other bill, the Taxation Laws Amendment Bill, it includes many of the more technical amendments that were proposed in the budget. Some of those are in Chapter 4, and a lot of those are in Annexure C of the budget review. There are many pages of legislation and amendments there, but it covers, for example, personal income taxes, business taxes. It covers changes to the value-added tax. It covers changes to carbon taxes, and others. The Tax Administration Laws Amendment Bill is SARS can present on those aspects, and it includes measures that are mostly administrative in nature. So it's less policy-related issues, but it's in terms of how SARS administers the law and what their powers are. I'm just trying to get the slides up. Maybe I should try on my side. Apologies, members. 1 second. Oh, there we go. Okay, so I've gone through an overview of those 3 bills. If you go to the next slide, on slide 5. So in terms of the process, it is good to go back through just how we've got to this point. So we did publish that draft rates bill on the 12th of March. We then had public workshops on the 4th of April to discuss the comments that were submitted. The rates bill was then introduced on the 24th of April. and to contain those rate adjustments in the 2025 budget. The 2025 T-Lab was published for public comment on the 16th of August. So we've had a period of comments for public consultation. So those comments were submitted to us by the 12th of September, which was last week. We are now going through those comments, and then we will hold workshops with stakeholders as well to discuss before the public hearings. If we go to the next slide. So just as a reminder that these bills are split into two types of bills. We have a Section 77 bill, which is the rates bill and the taxation laws amendment bill. Those are money bills, and because they deal with national taxes, they change the levies, they change the duties, and there is a separate requirement according to the Constitution in terms of how those are dealt with. The tax administration laws amendment bill, what we call the TALAB, is a Section 75 bill. So it's not a money bill, it's seen as an ordinary bill because it deals with the administrative actions required by the SARS. So we usually have those consultations with the public. The Standing Committee and the Select Committee normally have public hearings on those draft bills before their formal introduction. And we are planning to engage stakeholders through workshops on the 22nd and the 23rd of September. And then after that, we will provide a response to the Standing Committee on both our potential changes to the draft bills and the outcomes of those consultations and workshops. We then do provide a response document as well, where we go through all of the comments that are received. We say whether we accept them, whether we note them, whether we don't accept them, and the changes that we're going to make. And then usually we table that taxation laws amendment bill and the tax administration laws amendment bill during the MTBPS, which will be on the 12th of November. Okay, if we go to the rates bill. So this has been tabled already, but just to go through the amendments that are within this bill. Can you put it in presentation mode, Untitled? But okay, I'll talk to those issues as we are working on them. So the rates bill mainly includes the main rate adjustments that are included in Chapter 4 of the budget review. So for example, we made changes to excise duties on alcoholic beverages. Those were increased by up to 6.75%. We also made changes to cigarettes and cigarette tobacco excise duties that was supposed to be in line with the expected inflation at the time of 4.75% and was slightly higher for pipe tobacco and cigars. We did the same for electronic nicotine and non-nicotine delivery systems, which was in line with expected inflation of 4.75%. We did do a change on the ad valorem excise duties for smartphones. So the ad valorem excise duties are almost like a luxury VAT, and their replacement, it acts as a luxury VAT, where there are a number of items where this additional excise duty is charged, and we have a list of those, and they are usually luxury items. However, in consultation with the Department of Communications, smartphones are not really seen as a luxury item anymore, and everybody needs them in the effort to try and improve integration and digital access for the public. We have then tried to adjust that ad valorem excise duty for smartphones to say that if the value of that phone does not exceed 2,500 Rand, then there won't be an excise duty on that anymore. That was also included in the rates bill. There was an inflationary increase in the health promotion levy that had been legislated in a previous year that was to start on 1 April 2025. This rates bill cancels that inflationary increase. Government needs to do a little bit more work to see the impact of this health promotion levy on the industry, and we will have further consultations on that. But in the meantime, we've cancelled that inflationary increase. If you go to the next slide. It does also extend the urban development zone tax incentive that had a sunset date, which I think was 2025. and we've extended that for an additional 5 years. We will then review it at the end of that period. We have been in contact with some municipalities about the effectiveness of that incentive. We need more municipalities to come forward and work with us on checking how it can be either adjusted or refined. And in the meantime, we are extending it for 5 years to try and create a bit of certainty. The employment tax incentive, the bands on which the employment tax incentive applies, for which employers can then access the incentive, had not been adjusted for inflation for a while. This was an increase in those amounts to try and both adjust for inflation and an increase in the minimum wage. We changed the formula slightly. The values of how much you could claim did not adjust, but the bands did adjust. We've also adjusted the carbon tax recovery amount. So that is for the liquid fuel sector, they pay a carbon tax, but the price is regulated. So they don't have any ability to adjust. We have therefore included this cost recovery mechanism within the for the liquid fuel sector. That increases from 0.69 cents per litre to 0.99 cents per litre because of adjustments in the headline carbon tax rate. So those are the main adjustments in the draft rates bill. We will now get onto the draft taxation laws amendment bill, which contains quite a number of quite a few more amendments, and a lot of them are quite technical. And I'll ask Untitled to start, and I'm sure he will then ask the technical experts in the different areas to come in when they are required. Thanks, Honourable Chair, Honourable Members. I'll pass on to Untitled.
Thank you, Chris. And the next slide, basically, we're actually going to deal with the individuals and savings and employment. However, we have structured, Chair and honorable members, into different presenters who will come in. The first one on the individuals and employment and savings, Zalisile will come in and take us through the entire part. Zalisile, please come in.
Thank you, Honorable Chair. Thank you, honorable members. Thank you, Tata, for the introduction. Honorable Chair, I will be taking the committee on the individual savings and employment section. We have about 6 proposals that are currently in the bill. With regards to the amending of the definition of remuneration proxy. Also, we'll be looking at clarifying the inclusion of amounts that are assigned to non-retirement fund member spouses. Also, we'll be looking at the reduction of the threshold when it comes to the ring fencing of assessed losses. We'll also be looking at reinstating the exemption that was there before with regards to child maintenance payments that are funded from after-tax income. We'll also be clarifying the payments of death benefits, Chair, and also we'll be looking at the cross-border tax treatment of retirement fund benefits. Next slide. Chair, on this one, honorable members, we are looking at amending the definition of remuneration proxy. The current definition of remuneration proxy does not include foreign employment income that is exempt in terms of Section 10102. So what we are proposing, Chair, as government, is that the exempt foreign employment income is included in determining the amount of remuneration proxy. And the amendments will be actually made on Section 11, which is in the definition of remuneration proxy itself in the Income Tax Act. Next slide, Khatebe. Thank you. Also, Chair, we'll be looking at clarifying the inclusion of an amount assigned to a non-member retirement spouse. What happens here, Chair, is that this is a consequential amendment because of the changes that were made to the Pension Funds Act last year. So what we are going to be doing as a consequential amendment in the Income Tax Act is actually to draw what is in the Pension Funds Act in terms of deducting from a member's retirement savings in the fund any portion of the pension interest share allocated to a retirement member spouse in terms of a court order. And this court order is actually granted in respect of division of assets of a marriage. So this is upon dissolution of a marriage, in terms of or according to the tenets of a religion, Chair. So, honorable members, here we are proposing that an amendment in the Income Tax Act is made so that we can be able to align the Income Tax Act with the developments of the Pension Funds Act. Next slide. Chair, on this one, honorable members, we are looking at reducing the threshold for ring fencing of assessed losses. And in this proposal, government is actually seeking to lower the taxable income threshold from 45%, and we are actually proposing that we start from 39%, so that losses from activities that are not genuine businesses, Chair, honorable members, the so-called suspect trades, are properly ring-fenced under Section 20 Cap A. Next slide, Mr. Khadebe. Honorable members, honorable chair, this one is with regards to the exemption for child maintenance payments. What we are seeking to do here is that child maintenance payments, chair, funded from after-tax income are currently taxed in the hands of the recipient. This is the carer of the child and the child's well-being. So what we deem to do here, Chair, is that, or what we seek to do here is that we want to align social policy objectives of government with the intention that child maintenance payments funded from after-tax income remain tax neutral, Chair, in the hands of the recipient, the carer of the child. Because these amounts, Chair, are intended solely for the upbringing and the welfare of the child. And these amendments will be made in Section 1010, which will actually be the exemption for such amounts. Thank you, Mr. Khadebe. Next slide. The previous one, Khadi, on death benefits. Yeah, slide 17. Thank you. Chair, honorable members, this one is with regards to the payment of benefits. This what we have seen, Chair, is that the definition of savings component currently, the way that it is written, it could be interpreted that a member who passes away, the amount that is going to be received by the beneficiaries will actually be taxed as ordinary income. And this is not in line with the other components, the vested component and the retirement component. So what we seek to do here, Chair, is to amend the Income Tax Act so that we have consistent outcomes across all components, the vested component, savings component, and the retirement component. So what we are proposing, honorable members, here is that on death of a member, the full value of the vested retirement and savings components can be paid as a lump sum to the beneficiaries, and it should be subject to the tax rates applicable to retirement lump sum benefits, Chair. Thank you, Mr. Khadebe. Chair, on this one, this is the last proposal for the section in personal income taxes, and it's with regards to the cross-border tax treatment of retirement funds. Chair, honorable members, foreign retirement benefits received by South African residents currently are exempt in terms of Section 101G Cap C 2. And what we have actually seen is that this results to double non-taxation or forfeiture of South Africa's exclusive rights to tax under a double tax agreement. And what we are trying actually to do here is to align the intended objectives of government with what the exemption was intended to do, Chair, honorable members, which is to prevent double taxation. But in most cases, what we have seen is that for foreign retirement benefits received or accrued or annuities foreign annuities that are received, Chair, or accrued to South African tax residents who are taxed on a residence basis of taxation. So they're taxed on their worldwide income and gains, Chair, is that there is no alignment at the moment with what is in the double tax treaties in terms of the general treatment of the double tax treaties, which gives the taxing rights, the exclusive taxing rights generally to the country of residence, Chair. Next slide, Mr. Khatebe. So, Chair, what we're aiming to do here, or what we're proposing, Chair, is that for South African tax residents who receive private pension interest or savings from another country, is that we are not currently taxing them, but we have the taxing right in terms of the TTA. So we want to align this principle and shift towards South Africa have exercising its right to tax, Chair. What would happen, Chair, is that there shouldn't be any tax on the other country because South Africa will be exercising its right, Chair. But the main intention here, Chair, is not to create double taxation, is actually to address issues of double non-taxation, Chair, and also to restore South Africa's taxing right, Chair, when it comes to this. Thank you so much, Chair. Thank you, honorable members. I will give back to you, Chair, but Khatebe might want to continue with the presentation, Chair, to business taxes. Thank you so much.
Okay, no, thank you, Zalisile. At the same time, apologies, I'm still struggling. I'm not quite sure why this presentation doesn't go to the slideshow. Then the next one is on the income tax business general. So there were a couple of as well of amendments here, and then I'll also just ask my colleague Arno to come in quickly as well. Arno?
Thank you, Nhlahla. Morning, Honourable Chair and Honourable Members. The next part of the slideshow would be business tax general, essentially your corporate income taxes and the proposed amendments. For business general, there are 7 topics that we will be discussing, myself, Haile Erasmus, and Nhlahla on the CIS amendments. Thank you, Khatebe. The next slide. The first 2 issues to deal with are the third-party backed shares and hybrid equity instruments. As far as it relates to the third-party backed shares, the Income Tax Act contains certain anti-avoidance rules to deal with third-party backed shares, where a third-party backed share is essentially debt funding structured as equity shares to obtain certain tax benefits. The third-party backed share generally takes the form of dividends guaranteed by a third party through an enforcement right by the holder of that share. This anti-avoidance rule is generally triggered when either dividends or when dividends are received, and secondly when the share qualifies as a third-party backed share during that tax year, and third-party backed share and its requirements being defined in the Act. So, unfortunately, government has identified structures that allow holders to strategically waive the enforcement right before receiving dividends, effectively bypassing the anti-avoidance rule. As a result, government proposes amending legislation to extend the anti-avoidance provision to cover those strategic disposable enforcement rights of holders, and essentially creating a once captured, always captured rule to limit the instances of abusing or bypassing the anti-avoidance rule. Thank you, Khatebe. Next slide. Next. Yeah. The next proposed amendment is Section 8E of the Income Tax Act, similar to 80A. It deals with those instances where debt is essentially structured as equity shares to obtain certain tax benefits. So in general, Section 80 stops this by taxing these preference shares as if they were loans, but the law is only applied to those with a term of 3 years or less. It has come to government attention that there are structures where these preference shares are, in a simplified case, is just structured as a product of 3 years and 1 day, essentially bypassing the entire anti-avoidance provision. To close the loophole and to, again, look at substance over form, as we said, it's essentially a loan disguised as an equity transaction. We looked at substance over form and proposed applying certain accounting principles from IFRS to apply to it and to match it where in the, as an example, in the financial statements, product like that would be pierced and would be rather shown as debt. It was published, and since we have retracted our proposed amendment to the definition of hybrid equity instrument, after we received numerous concerns from commentators and industry itself about the impact of our proposed amendment and the wide-ranging impact that it would have on finance structures like pref shares that would affect the ability of banks and other companies and transactions to raise funding. We have since then published the retraction with undertaking to further engage with all the relevant stakeholders to make sure that we do have an efficient piece of tax legislation that protects the fiscus, but also takes into account the role of very necessary equity or financing availability for certain transactions. Thank you. Khadebe, next slide. On this one, just going to pass over to Haley Erasmus, who is the topic expert.
Good morning, honourable members, honourable chair. So the idea behind this change is really to enhance certainty for taxpayers. So in calculating your taxable income, there are some provisions in the Act. So for example, if a company wants to make a donation to a public benefit organization, they're allowed to deduct that up to 10% of their taxable income. And it wasn't clear to them whether they should calculate that 10% amount at which step of the calculation, given the assessed loss rules and the assessed loss restriction rules. So all this seeks to do is to clarify for them the ordering of that and at which point they should calculate that 10%, for example. Thank you.
Thank you, Haley. Then the next issue.
Then Arno, you're going to come in for the contributed tax capital?
Yeah, am I audible?
Yes.
Thank you. The next issue deals with CTC, or contributed tax capital. Contributed tax capital is a notional tax amount that is used to determine the capital cost of share investments. In 2017, government introduced anti-avoidance measure to the concept of CTC, essentially to prevent resident companies from artificially inflating their CTC amount to enable non-resident group entities to avoid dividends tax through the interposition of additional foreign companies between the foreign HCO holding our shares in our South African subsidiaries. It has come to our attention that the rules may unintentionally be overly restrictive, especially in those instances of legitimate equity transactions involving minority shareholders. As such, it is proposed that legislation be relaxed to allow for equity transactions to be used for the buyout of independent minority shareholders, where unfortunately the current legislation, it is potentially caught. So to extend it or to relax it a little bit more to allow for certain legitimate transactions. Thank you. Then just the next slide. Next one. The next issue on screen deals with asset for share transactions in terms of Section 42 of the Income Tax Act, which falls in our corporate reorganization tax packages available to taxpayers. So our corporate reorganization tax rules specifically contain rollover provisions to ensure tax equity in legitimate asset for share or share for share transactions. Essentially, the acquiring company inherits the target shares that it is buying with the same tax character and tax costs as is currently held by the original shareholder that it is buying that specific share from. However, in instances of listed shares, it has been government's intent to simplify the identification of that historical tax attributes in a scenario of a listed company which potentially has hundreds, if not thousands, of possible shareholders that the purchaser needs to buy those shares from. At issue is that the current legislation does not clearly and effectively address government's policy intent and the practical tracing problem of the purchasing company to identify each specific shareholder's tax cost and tax structure if that shareholder had held it as a capital asset or as a revenue asset, which have different tax implications. So as such, we are just proposing amendments to our legislation to clarify and give further credence to the policy of giving tax value certainty and to target shareholders holding less than 20% of the listed company equity, and to further simplify that procedure and make it clear how these purchasing companies should handle their transactions. Next share. Okay, and then CISs, I'm handing over back to you and Slashla, the topic expert.
Okay, Chair, this one basically, there's been this issue that we experience where, because firstly, at most, that the CIS itself, there's an issue that is a flow-through entity. So meaning that the income is actually passed directly to the investors who then declare it on their personal tax returns. So then now the issue with the CGT is that it is not triggered as well when the CIS sells the asset. Instead, the capital gains tax get triggered when the investors themselves sells the unit. So what has then happened is that because as well we also have this rollover provision rules that defers, so to say, the tax during the corporate restructuring to support business, to support legitimate business transactions, we then realize that at some point, some of these CISs now at the moment, they are using it and then they're deferring the payment of tax. And then eventually, so on that basis, then we were trying to make sure that those sections, the rollover relief, no longer apply to the collective investment scheme. So I think in a nutshell, that's what we're trying to do here. And then on the next one, it's section 23M, Hayley.
Thanks, Nhlanhla. So you'll recall over the past few years, we had a review of the interest limitation rules, and one of the things that we tried to do in that review was broaden the definition of interest. And that was to ensure that taxpayers didn't label other items such as foreign exchange losses, for example, or use that to circumvent the rules rather than having pure interest. Unfortunately, it created a bit of complexity in the legislation, so we've had to relook at that and think about how we can enhance certainty for taxpayers, which is important. So these changes have sought to do that, and we'll have engagements with them next week to determine whether we've managed to achieve that. One example of these is where, for example, in the calculation to determine how much interest should be restricted to be deducted in 1 year, you have to calculate adjusted taxable income. And because we've widened the definition of interest, there are a whole lot of other elements like forex gains and losses that are attached to third-party debt, for example, that we wouldn't necessarily want to burden taxpayers with calculating. So that's what we're seeking to do with this change. And also, for example, where you have a forex difference, it's recorded in the South African debtor's income statement, but it doesn't actually accrue to the creditor on the other side. So that presents a challenge as well. But I'll stop there. That gives a brief overview. Thanks very much.
And then the next one, basically, it's a couple of amendments. Let me try and get there quickly. The first one is it's basically the alignment of the tax treatment of dividends with the accounting treatment by covered persons. Generally, the covered person in this instance refers to banks because they are the ones basically who are using these provisions. An issue, in any case, it's much more about matching here. So what has transpired is that some of the banks are actually investing in shares to receive dividends. And then those dividends, they then hedge positions in other instruments where the payments are deductible for tax. So what we're seeking to do is that in order to achieve the matching, the tax treatment of the dividends accruing from the hedges it should then be taxed. So that will then align the tax treatment of those dividends with the financial accounting of treatment of those dividends received. Next one. On this one, it has been an outstanding issue on this part because the key issue is that at some instances, because the capital gains that is actually that is realized by the fund. It's not taxed at the fund level, at the CIS level. So, and then I did state earlier that the investors are only taxed on the capital gains when they sell the units, which is now based on the difference between the sale proceeds and the original cost. However, the issue now is that the current legislation doesn't have guidance on how to treat capital distributions from a fund that is still operating. So then what we're then trying to do now is to come up with some rules to say, to the extent that there is that capital distribution that happened within the fund, we should be able to tax it. And then we had issued a paper last year of which we were trying to propose that the base cost of that asset must be reduced. However, after comments, we will then change and then go for a simpler alternative where we are now saying all capital distributions be treated as a capital gain. And then the next one, Chair and Honorable Members, this one is in relation of that first loss after capital instrument, which are designed to absorb losses during bank's resolution and ensuring that the cost of failure is actually borne by the shareholders and not the creditors, and the creditors rather than the public payers in case there's a bank failure. So in order to support this resolution, we then have to align some of the sections within the income tax to make sure that these instruments can be issued by the banks without having without creating a tax liability for the banks. That's that one. And then we're now going to go to the income tax, the incentive part. We've got the UDZ incentive and the one amendment relating to battery, electric, and hydrogen powered vehicles. And then I'm going to give it to Londiwe to take us through those two. Londiwe.
Thank you, Nhlanhla. Good morning, honorable members and chair. I will take you through the UDZ tax incentive proposal. Chris had already mentioned earlier that we are proposing to extend the incentive for another 5 years until 2030. This is to allow us to finalize the review. And so far, as part of the review, we had conducted an online survey just to gather the experience of the various stakeholders. However, there is a need for us to further engage the various municipalities so that we can gather the data that we need to better understand the uptake of the incentive. Next slide, Ntlatla. And then on the battery electric powered vehicles, this incentive was introduced last year, and it's intended to support investment in local production of battery electric vehicles, as well as hydrogen powered vehicles. So during our interaction with stakeholders last year, they indicated that we have to include a definition for the term motor vehicle manufacturer so that it's clear who is eligible for the incentive. So here we are just proposing to include a definition so that is clear in terms of eligibility, and we intend to then align this with the existing legislation in terms of the APDP2 as well as the Customs and Excise Act. Thanks, Ntlanhla. That's it.
All right, then the next one was the amendment that were in relation to the international tax. There were a couple of amendments there. Let me just go through them quickly. The first one basically was the fact that currently there is a definition of an equity share that doesn't necessarily reflect the foreign company. So, or if you have a share in a foreign company. So what we're trying to do in any case was just to update the definition in this instance of an equity share. Then this one basically, what was it, the 23M1. So an issue is that you have two sections that needs to interact. You have section 23M that limits the deduction related to employment. And then you also had section 6 quad that permits deductions against any taxes paid or proved to be paid outside South Africa. So an issue now was that some of the employees or office holders will not be entitled to claim a deduction under Section 6 quad because of the limitations that were imposed by Section 23M. So currently what we're trying to do, we are trying to explicitly state that Section 23M is now being expanded to cater for Section 6 quad, to cater for those proved to be paid taxes in a foreign country. This one, the Section 9D and Section 9H interaction of a controlled foreign company rules. This one, firstly, the Section 9D seeks to prevent residents from diverting income into a foreign company. So, and this foreign company, that's the issue. It's now CFC. And then Section 9H seeks to trigger the exit charge. So when a resident ceases to be a controlled foreign company. So now what has then transpired is that we have now picked up that the current wording of both of these sections may fail to trigger the exit charge when this controlled foreign company loses its status, which means ceasing to be a controlled foreign company. So we're amending the wording there. Then this one on controlled foreign company and comparable tax exemption. Briefly, the comparable tax exemption refers to an aggregate foreign taxes payable by a controlled foreign company. So now an issue is that the wording is not wide enough to deal with tax systems where the shareholder obtains a refund of the tax paid. So also here we're trying to broaden the wording as well in this instance. Taxation of trust. Basically, what we're saying here is that the flow-through principle should be limited to resident beneficiaries. I think then we made an amendment in 2023 to ensure that. However, the key issue why we made it that way was that it became challenging to identify or collect taxes from a non-resident in whom the income is vested or distributed. And therefore, we then have to make this amendment just to clarify that, to ensure that the flow-through and the attribution principles apply to income received by or accrued to resident beneficiaries. And then the section 24I, this one basically what happened, it actually stems from 2012. So in 2012, we introduced a subsection, subsection 10 Cap A, that was to delay the taxation of foreign exchange differences until those foreign exchange differences are realized. So, but then what has now transpired a bit, it's like there is that intentional by some of the taxpayers not to realize these exchange items so that they don't trigger the deferred foreign exchange gains. So what we are now trying to do now, we're saying the deferred exchange differences can be triggered. The portion that has been realized this year should be triggered and be included in the taxable income of those taxpayers. And then now on the value-added tax, I will then ask Mpho to come in there. Mpho?
Thank you very much, Nhlanhla, and good morning, Honorable Chair and Honorable Members. I'll be taking you through the amendments that have been proposed in the draft taxation law with regards to value-added tax. First, dealing with the issue around debit and credit notes relating to going concerns. The proposed amendment just seeks to bring parity between going concerns that are conducted under the different circumstances, but in substance are the same. Currently, where a business is sold as a going concern, and then the purchaser wishes to return the goods after the business being transferred, the VAT Act allows for the issuing of debit and credit notes, but when similar circumstances are done under the group restructuring conditions, the VAT currently does not permit for the issuing of debit and credit notes for those goods that are returned to the new owner. So this amendment just seeks to bring parity between the issuing of debit and credit notes under those different circumstances. Next slide, Nhlanhla. The other amendment that we're making, we're just reviewing the scope of intermediaries. Currently, the VAT Act allows for intermediaries to account for VAT on supplies made on behalf of only foreign suppliers of electronic services, but the experience to date is that some of these intermediaries, they also provide electronic services on behalf of local suppliers. So we just want to broaden the scope around the intermediaries accounting for both the supplies that they do on behalf of local suppliers and also the foreign suppliers. The current provisions only limit the intermediaries to account for supplies that they make on behalf of foreign suppliers, and it becomes administratively difficult in terms of separating those transactions that are done on behalf of foreigners from those that are done from local suppliers, especially when we have those sort of like consolidated invoice from one consumer who buys both from foreign suppliers and local suppliers. So we want to just ensure that intermediaries can account for both if they are doing that on behalf of both the local and foreign suppliers. Next. And also, we're looking at the reviewing the VAT rules dealing with the documentary requirements for silver exports. Currently, we have the rules that govern the documentary requirements for the zero rating of exports for gold, and we have made those amendments because there is quite a rich documentary a burden and requirement that the gold smelters hold on behalf of the depositors that deposit gold for export, because the issue has been that they have this gold refineries that export gold on behalf of depositors. They will melt all the gold together and export on behalf of the different depositors, and they provide documentary evidence for all of that. So what we have seen is that there is a similar request around the exports of silver, where the scheme operates similarly to the scheme around gold export. So we're just bringing parity between the regime for gold exports with the silver exports. Next, Nhlanhla. And another issue that has been problematic in terms of the current legislation was with regards to the zero rating of certain testing services, such as for that are done for clinical trials. So the current provision around the zero rating of testing services performed in the Republic on behalf of non-residents cannot be zero rated since they are regarded as being performed directly in the Republic and in relation to movable property, such as medicines and devices, which are in the Republic at the time of doing those clinical trials, and subsequently are not subsequently exported. But the results of those clinical trials and all of that, they are performed on behalf of a foreign or a non-resident. So in order, therefore, to address some of the difficulties around the clinical trials that are done in South Africa on behalf of non-residents, we are proposing an amendment to be able to zero rate those services that are performed on behalf of non-residents, so that the companies that do provide those clinical trials are able to zero rate the services related to those clinical trials, and also some of the items and equipment that is used to perform those clinical trials. So we are providing for the zero rating of those items. Next, Nhlanhla. We're also sort of reviewing the definition of insurance. There's been a court case around the insurance and how the insurance is being defined in the VAT Act, where the Constitutional Court has made a ruling around the insurance, where it's given to clients by suppliers, where there is no consideration. And currently we're then proposing that in light of the outcomes of the Constitutional Court, then we propose that the definition of insurance be revised to include the requirements that a premium be charged on the insurance. Also, we're looking at reviewing the VAT treatment of letting of residential property. Currently, residential property developers generally they develop the properties for sale, but then there are circumstances where immediately after the completion of the development, they are not able to sell those properties, and therefore are forced to hold those properties and rent them out whilst they are still looking for buyers. So in those instances, there is a change in use in terms of how the VAT Act views or treats residential property that is developed for sale, and also residential property that is developed for rental, with the former being a taxable supplies and the rental income being an exempt. There is a change in use that the developers need to take into account, and therefore account for the VAT that they would have claimed when they were developing the property for sale, because that is a taxable a supply, and now they are moving to an exempt supply. Therefore, there is a clawback in terms of the adjustment that they need to make, because now they are moving into an exempt supply. Previously, we had made some adjustments to just provide relief for the developers, where we allowed a period of 12 months of relief where they can still look for buyers without requiring them to make the adjustment in use, and also not requiring that there should be a clawback of the VAT that would have claimed in the development of the properties for sale. Now we are proposing an amendment to ensure that there is a corresponding input tax adjustment on temporary adjustment be made, and so that you don't have issues around the timing of when these properties are moving from being rented towards being sold. Also, we in this draft taxation law amendment bill, we're looking at supplies of educational services. Currently, educational services are exempt, and therefore the activities that are done by the services that are provided by educational services and all the related supplies and then the purchases that are made to provide that educational services will be exempt, meaning therefore that the input tax is denied in those instances. But then there are also these other activities or supplies that those that provide educational services engage in, which are taxable supplies. And there's been an issue around, those providers of educational services where they provide those mixed supplies, and therefore the VAT requirements around accounting for VAT for those mixed supplies. We have received the request around providing relief around excluding the educational service providers from the requirements of having to account for VAT, because they don't have the capacity to deal with the VAT requirements around accounting for mixed supplies, and therefore ask for total exemption from VAT. So this proposal seeks to therefore then exempt educational services from the VAT net, and that event is by itself means that for those that have been providing mixed supplies, and that portion of taxable supplies therefore then have to be a clawback, because input tax would have been allowed on that portion of the taxable supply. Now that we are proposing a total exemption of the services provided under educational services, it therefore means that there has to be a clawback. And we have proposed that in those instances of a clawback, therefore there's an arrangement around the period that is allowed for those educational service providers to make arrangements with the commissioner or with SARS around the payment of the clawback of the VAT that they would have claimed on the portion of the taxable supplies that they were providing. So this amendment is intended to take effect from 1st of January next year. So this amendment basically will take educational services out of the VAT net. Next. We're also reviewing the VAT treatment of airtime voucher supplied in South Africa for exclusive use in export countries. What is currently happening is that you have the supply of airtime vouchers in South Africa that is done through the distributors in a foreign country, working with the distributors in South Africa, selling vouchers to foreign nationals that are in South Africa, but those vouchers are for airtime that is used in a foreign country. So in those instances, we recognize that there are about 2 transactions that are actually happening where the local distributor of those vouchers is providing a service in South Africa, and which is a taxable event. But also the airtime itself is used in an export country because the telecommunication that it is used for the airtime is in a foreign country. In essence, what happens is that if a foreign national in South Africa will be buying this voucher from a local distributor, but that airtime voucher is sent and is exported to a foreign country, where then the locals in the foreign country use that airtime in that foreign country, and that is a zero-rated event. So the proposal is around that, the revision of the legislation to cater for those 2 transactions, where one is zero-rated and the one which is the local supply of the voucher in terms of the distribution services that is provided, that is taxable. So the use of airtime happens outside the Republic, and therefore it is out of the scope for that. So we are providing for that distinction. Next, and also one of the things that we have been having in the VAT Act is that low value imported goods. We have been applying a threshold where goods of a value of 500 Rand or less that don't pay a custom duty, that there was a VAT that was therefore not paid. It was linked to the payment of custom duty, meaning that where a custom duty is not paid for those low value goods under 500 Rands, that was not charged. And then also we had a provision where printed books, newspapers, or journals or periodicals that are imported into the Republic by post not exceeding 100 Rand in value are exempt from that. But what has happened country, and therefore it places the local suppliers of the similar goods in a disadvantaged position because they have to account for VAT on those low value goods, but the imports of the same low value goods have been exempt from that. So we are bringing parity in terms of taking away those thresholds where therefore there will no longer be exemption of low-value goods in the VAT system. So we are removing the threshold so that we provide a level playing field for both local and offshore suppliers of these low-value goods. And this will hopefully bring in some revenue that the fiscus need. Next. And then also in terms of the current legislation, we're just bringing, clarifying the VAT treatment in respect of payments under the National Housing Program. Currently, what in the VAT legislation, what we had was that we had the zero rating of what is known as the RDP houses. That the Department of Human Settlement are supplying to the indigent, and we had provided for zero rating. And over time, the scope for that the housing program was expanded, but that expansion of the program that is covered under zero rating has resulted in a lot of other supplies being included in that housing program that, for example, rental properties that are provided by the Department of Human Settlement, which is rental properties are exempt, being included in the scope for the housing program, which qualifies for zero rating. So in this legislation, we are proposing that we amend the zero rating provisions to narrow the scope of the zero rating, so that we don't have situations where supplies that should not be qualifying for zero rating getting the benefit of zero rating because they are part of a broader national housing program. So we are narrowing the scope to specify that the zero rating will be only limited to RDP houses as it was initially envisaged. Next. Thank you very much. I will hand over to my colleague to deal with the carbon tax amendment. Thank you, Chair, and thank you, honorable members.
Okay, no, thank you, Mpho. We're going to go through some of the amendments that were made in the carbon tax. And then I'm going to ask my colleague, Charlene, to come in on those amendments. Thanks, Charlene.
Thanks, Nhlanhla. Good morning, Chair, and good morning, honorable members. You can go to the first slide, Nhlanhla. So we have the carbon tax in place since 2019. It forms part of the package of policy measures that we've implemented to address climate change. And we had the National Climate Change Act enacted last year in July. The Climate Change Act sets out some of our mitigation policy instruments in addition to the carbon tax. So this includes instruments like carbon budgets and sector targets, and they together contribute towards how we will be reducing our emissions there. So under the Paris Agreement, South Africa has made commitments to reduce our emissions. It's expected that our emissions will peak this year in 2025 in the range of 398 to around 510 million tons of emissions, and decline from 2026 to 2030 to a range of 350 to 420 million tons. A large part of these emissions will be required in the electricity sector in order to help us achieve these targets that we've set out. There is also a process through our Department of Environment to develop the NDCs for the period 2031 to 2035. So the carbon tax is a part of this package of policy measures. It seeks to give effect to the polluter pays principle, and it internalizes these costs of climate change into the prices of goods and services. The intention is to ensure that these costs are taken into account, not just in current decisions, but in future decisions of producers and major emitters, so that we are not locked into a carbon intensive pathway. Next slide. So the current design of the carbon tax caters to it helps us with the transition that we are trying to make, and it also provides emitters with the time to make the investments needed in order to lower their emissions. It was introduced at a very low effective tax rate, and there are significant tax-free allowances ranging from 60 to 95%. So basically a company on the margin will be taxed on around 5% of its emissions only. And the first phase of the carbon tax was initially from 2019 to 2020. However, taking into account the challenges with COVID and the economic situation, in 2022, that phase was extended for a further 3 years to 2025. Among some of the measures that were extended at the time is that the carbon tax includes these tax-free allowances, but it also includes other revenue recycling measures. The two main ones that we have in place is that some of the money is used to fund the energy efficiency savings tax incentive. And the second part is that we provide for the introduction of the carbon tax, but it would have no impact on the price of electricity for the first phase. So those measures together with the tax-free allowances ensure that the carbon tax comes in at a relatively modest rate, but provides those signals on the margin for behavior change. In the 2022 budget, we announced that we would also be looking at ways of adjusting the carbon tax, given that South Africa has taken on the targets to be more stringent from 2026 to 2030 and for emissions to be reduced. So we made announcements to indicate that we will be looking at ways to strengthen the effective carbon tax rate and to tighten up on the price. In 2024, we then published a discussion paper outlining some of the proposals for the second phase of the carbon tax, which included measures to reduce some of the allowances as well as extend some of the concessions under the carbon tax. We received about 56 sets of comments from a wide range of stakeholders. These comments were considered and reviewed and presented at a stakeholder consultation workshop that was held in January this year. Based on the comments received, the proposals were announced in the 2025 budget. We can go to the next slide. So the main proposals that we put forward in the 2025 budget was to essentially continue with the second phase of the carbon tax and some of the concession measures and recycling measures that we have put in place. So firstly, we indicated that the energy efficiency savings tax incentive, which comes to an end this year, that will be extended for a further 5 years until 2030, and this will encourage companies to make additional investments in energy efficiency and change their business practices. We can go to the next slide. The second part is that under the carbon tax, we made a commitment to no impact on electricity prices for the first phase until 2025. This is achieved in two ways. So currently, electricity generators pay an electricity generation levy of 3.5 cents per kilowatt hour. So that payment of that electricity generation levy can be offset against their carbon tax liability. And the second part is to the extent that there are additional purchases of renewable energy and electricity that is made through the Independent Power Producers Program or from other independent power producers, then the cost of those purchases can also be offset against the carbon tax liability of the entity. So essentially, the electricity generators currently pay a zero carbon tax. This was put in place to address concerns at the time about double taxation, with having in place the electricity levy as well as the Renewable Energy Independent Power Producers Program. We can go to the next slide. So the 2024 discussion paper proposed to extend this commitment to electricity price neutrality until 31 December 2030. This is to address concerns around the high electricity prices that we've seen and to limit potential adverse impacts on households and energy-intensive users, as well as help to facilitate a just transition. It also takes into account the proposed amendments to the Electricity Regulation Act that are expected to come into place in 2028 to open up the market and bring in independent power generators there. So the extension to 2030 provides sufficient time for that market to develop as well. So how will we achieve this in the current design? Is that firstly, we will be repealing the electricity generation levy and only apply the carbon tax on combustion emissions from the 1st of January 2026. And then the second part is we are continuing with the offset of the renewable energy premium against the tax liability of electricity generators. And that will be extended to 2030. And the difference between the carbon tax liability of an entity and the electricity levy liabilities that they have can be offset using this renewable premium. So the tax is still neutral in that the only levy payable is the amount in terms of the electricity generation levy of 3.5 cents per kilowatt hour. We can go to the next slide. So in terms of the Climate Change Act, our Department of Environment has developed sector targets and carbon budgets. Carbon budgets essentially is placing a cap on emissions of a company. There's been an extensive process on the development of carbon budgets, on the methodologies that's to be used to allocate these budgets and caps to companies. And the carbon budgets is to be introduced in two ways. So the first part was the introduction of the voluntary carbon budget system from 2016 to around 2020. And this was to encourage companies to submit data to the Department of Environment and work on a process with the department on the kind of budget that can be allocated to them, taking into account the options and technologies available to them to reduce their emissions. So that voluntary system applied from 2016 to 2020, and then it was extended up to 2025 this year. There's a mandatory carbon budget system that is also coming into effect, and that is in terms of the Climate Change Act. And there were various discussions over the past 6 or 7 years, or probably longer, together between the National Treasury and the Department of Environment and various stakeholders on the options to align the carbon tax and the carbon budgets, especially the mandatory carbon budgets. And as part of those engagements, there were options put forward. As part of the process on the carbon tax bill, that was submitted to Parliament in 2018. There was a discussion on these options, and it was proposed that to ensure compliance with the carbon budget as a standalone instrument on its own, a higher tax rate on those emissions would be applied where emissions exceed the budget that is allocated to an entity by the department there. In the 2023 budget, we made an announcement to propose the higher tax rate of around 640 Rand per ton carbon dioxide equivalent. And this serves as a penalty mechanism for non-compliance with the mandatory carbon budgets, but it also gives effect to a progressive carbon tax design. We can go to the next slide. So in the 2024 budget, we had made an announcement that this higher rate will be legislated through amendments to the Carbon Tax Act once the Climate Change Bill is enacted, which has now happened, and the Department of Environment gazettes the relevant regulations to give effect to the carbon budgets. And we had expected at that time that the budgets would be implemented in January of the calendar year once the legislation has been finalized. So we've had the Climate Change Act enacted, and we've had the Department of Environment recently publish the carbon budget and mitigation plan regulation. So that was published in August 2025. We can go to the next slide. So given that the Climate Change Act is in place and we have the relevant regulations in place, we are proposing amendments now to bring into place the higher tax rate of 640 Rand per ton. However, the effective date for this amendment will be announced by the Minister of Finance by way of a notice in the Government Gazette. The reason for this is because the effective date will have to be aligned with the implementation date of the carbon budget and mitigation plan regulations of the Ministry of Environment. We can go to the next slide. Coming back to the carbon budgets and in terms of the current design of the tax, we have the carbon budget allowance, and this was there, as I said, for the voluntary phase of the tax and to encourage companies to participate in the system and provide data to the Department of Environment, which would then be used to help them determine the budgets that can be allocated to the entities. So given that there's a slight delay in the implementation of the mandatory carbon budget system, we are proposing to extend this carbon budget allowance for an additional year up until the 31st of December 2025. We can go to the next slide. We come to some additional technical amendments that are made to the Carbon Tax Act. So currently, we provide a deduction for what we call emissions that are sequestered by the paper and pulp sector. So the activities in this sector basically can claim removals of emissions from the atmosphere or that are sequestered, and they can claim those emissions per ton and use that to reduce their tax liability. So this is for carbon stored in forestry plantations and harvested wood products. During consultations that we had in 2022, when we allowed for this sequestered emissions in forests and harvested wood products to come into effect, there was a proposal from industry to also extend this sequestration deduction to apply to timber grown and supplied by third parties, so not just by themselves, especially informal growers. Over the past 2 or 3 years, the Paper Manufacturers Association developed a methodology to be able to measure and report these emissions that are stored because it was important for us to be able to verify those emissions. We can go to the next slide. This methodology was reviewed by the Department of Environment and it was accepted in September last year. It's broadly aligned with the current tools that the department has for monitoring, reporting, and verifying emissions that are sequestered, and it will ensure that third parties timber sequestration meets all the standards of reporting for the sector. So it is proposed that we will expand the sequestration deduction for the paper and pulp sector to include the timber supplied by these third parties, subject to them being verified by the Department of Environment. We can go to the next slide. So we have the carbon tax covers fugitive emissions, which is emissions, for example, from mining such as coal mine methane, but any other emissions that leaks out of pipes, etc., in a within a plant and in a production facility. In Section 4 of the Act, we provide the formulas that are to be used by companies to calculate their greenhouse gas emissions and to determine the emission factors to be used. So this is to basically convert the emissions for for methane and nitrous oxide into a carbon dioxide equivalent measure. We currently have a formula in place that applies to oil and natural gas, and it is now necessary for us to clarify the formula to be used by taxpayers for some new solid fuel transformation activities such as coke production, biochar, and charcoal production, and for the coal to liquid fuel sectors that have now been included under the fugitive emissions category. So the current formula for oil and natural gas that is applied will be extended, and it can be used to calculate the emissions for coke, biochar, and charcoal production. We can go to the next slide. There. And for the charcoal production, where there's a fuel wood input, so it's based on the energy content, and the coal and gas to liquid activities, these emission factors are currently presented in the units of kilograms per terajoule of energy, and then tons of greenhouse gases per terajoule of energy. The current formulas can't be used because this requires us to insert a calorific value to convert that joules to tons. So we are proposing two new formulas that will enable that will help taxpayers and clarify how the emission factors can be converted to tons for these two categories of activities. We can go to the next slide. Thank you. So thank you, Nhlanhla. I'll hand over to Kushle, who will do the remaining 4 slides on the carbon tax and the diesel refund proposals. Thanks.
Thank you, Charlene, and good morning to everyone on the call. So the slide is with regards to aligning the Schedule 1 of the Carbon Tax Act to the emission factors that have been provided by the DFFE. So in 2023, the DFFE approved country-specific emission factors for natural gas and coal fuel types to be used by data providers or taxpayers for estimating and reporting on their emissions through fuel combustion activities. The department further approved country-specific carbon dioxide emission factors and net calorific value for methane-rich gas for the 2025 to 2027 emissions reporting cycle. It is therefore proposed that to align with the DFFE approved factors, there be changes made to the carbon dioxide emission factors and net calorific values for coal, natural gas, and methane-rich gas in Schedule 1 of the Carbon Tax Act. Thanks, Nhlanhla. Next slide, please. Thank you. So in terms of the carbon offset allowance, this allowance is provided for in the Carbon Tax Act and allows for 10% for combustion emissions, as well as 5% for fugitive and process emissions. In the 2024 carbon tax discussion paper, it was proposed to increase the carbon offset allowance by 15 percentage points in order to expedite low carbon investment, as well as to encourage low technology innovation. During the stakeholder engagement, stakeholders supported a lower increase to the carbon offset allowance due to the time that is required to develop offset projects, as well as raising concerns about the costs of project approvals and the insufficient domestic supply of offsets. It was therefore proposed in budget 2025 to increase the carbon offset allowance by 5 percentage points, from 5 to 10% for fugitive and process emissions, and from 10 to 15% for combustion emissions. Next slide, please. Thank you. So in terms of the diesel refund relief, which is implemented through the Customs and Excise Act, the relief was implemented in 2000 in order to provide refund, which was either a full or partial refund of the general fuel levy, as well as the road accident levy to primary sectors. This relief is provided to protect the international competitiveness of these sectors and to ensure equitable tax treatment of non-road users. The qualifying on-land activities are farming, mining, and forestry. These activities qualify for the general fuel levy and RAF levy on 80% of eligible fuel, diesel fuel purchases. Next slide, please, Dantla. This 80-20 policy of the diesel refund system was implemented with the rationale of minimizing potential abuse of the diesel refund system, and deemed that 20% of the diesel used is non-eligible for the rebate. It is now was proposed in the budget 2025 to apply the refund for all eligible diesel purchases declared to SARS and align with the original policy intent. This proposal is to simplify the administration of the diesel refund system and is estimated to provide an additional relief to taxpayers of about 1 billion rand. Thank you, Kandla.
Thank you, Buhle. Chair, honorable members, now we're going to go through the Tax Administration Laws Amendment Bill of 2025, and Mr. Franz Tomasek will come in after this. Franz.
Thank you, Nhlanhla, and good morning, Honourable Chair and Honourable Members. So we begin with tax-deductible donations to public benefit organisations. So public benefit organisations that undertake certain activities are eligible to issue Section 18A receipts, which means that the people who make the donations can claim them as tax deductions up to certain limits. And essentially then that means that the state is subsidizing the activities of those public benefit organizations. Now, a public benefit organization may conduct activities that qualify for Section 18A, and it may conduct other activities that don't. And where that happens, the legislation currently requires an audit certificate on the split between the activities. Now, there has been some debate about what this audit certificate means. Is this something that has to be issued by a registered auditor? Can a third party issue it? So SARS has tried to give some guidance here, bearing in mind that a lot of PBOs are quite small and probably couldn't afford a formal audit. But now to put the debate to rest, the proposal is that we replace the question, the term audit certificate with certificate of examination, and we just make it clear that this needs to be an independent person who does the examination. Moving on to the next slide. So there's also then the proposal the commissioner can prescribe the minimum information in the certificate so that we can align it with the kind of information that are required for a Section 18A donation receipt. Moving on. So members will be aware that there has been quite a bit of debate around SARS withdrawing the so-called 20% concession last year, where there was a concession where there was a tax, well, importers could declare goods that came in that were valued at under 500 Rand and pay only a 20% duty on that, which incorporated both the VAT and the customs. Now, the difficulty with that was, of course, that some of the imports were in respect of goods with much higher customs duties. And so that created a level playing field concern for local businesses. So that concession was withdrawn last year. And you will have heard earlier today that in cases where there's no customs duties, there's currently a VAT exemption on import, and that will also be withdrawn. So the question then becomes, well, what do you do now? You have a lot of packages that need to come into South Africa. And so this is a response to that. It's to provide for an expedited or simplified regime for goods coming in. And that's what this proposal is about. Moving on. Again, as is so often the case in the customs legislation, the commissioner would put the finer detail of how this would all work in the rules. Now we come to timing of the adjustments of bills of entry. So generally, when you discover there's an error in your bill of entry, so the documentation you provided when you imported the goods, you are expected to correct that without delay. But there are cases where that is going to be extremely difficult. And the example we give here is where SARS does a transfer pricing adjustment in the income tax space. So after the end of your close of your financial year and after you've submitted your tax return, SARS audits it and discovers that the price at which you purchased certain goods was incorrect, at least as far as the transfer pricing rules are concerned. So perhaps they were undervalued, or perhaps they were overvalued. Whichever the case may be, that has an impact on the customs value as well. But you are now potentially 2 years down the track. And the question then is, how do you correct your bills of entry without delay under those circumstances? So the proposal here is to permit a degree of flexibility around the time frame for adjustments under these kinds of circumstances. Moving on. So we've had a voluntary disclosure system in the Tax Administration Act since its inception. But as the Tax Administration Act suggests, it only applies to the taxes in South Africa and not to customs and excise. And the question has come up, well, should we not also then have a similar set of rules around allowing people who discover they've made mistakes to come forward, obtain penalty and potential criminal prosecution relief, but pay the actual underlying amounts that are due? And that then is what this set of legislation is proposing. It's to bring in a very similar system to that which exists in the Tax Administration Act for customs and excise purposes. So moving on. Now, this is a very important project as far as SARS is concerned. This is the VAT modernization project. Now, currently, VAT is very paper-driven. It's record-intensive. It requires a good deal of work, both by vendors who are registered for VAT and for SARS to then police the audit trail and ensure that the correct amount of VAT is being paid over. You don't have what is known as a missing trader in the middle, where someone claims to have charged VAT, but actually never pays it over to SARS, and then the next person in the chain deducts the VAT so that there's a net loss to the fiscus. So all of that comes together into a fairly complex system to administer. And it's complex for both taxpayers and for SARS. Now, the question then is, how can you make this easier? And that is part of what the VAT modernization project is all about. As is noted there, SARS strives for the best service is no service and encouraging voluntary compliance. And so how do we make that easier? And the idea here then, moving on to the next, is to start using the power of the electronic systems that have become so commonplace in modern life, and essentially allow both the vendors, when transacting amongst themselves and then reporting to SARS, to start making better and more consistent use of these electronic tools, which many of them are using, but in different ways. And so the idea here then is to create the concepts of in the legislation, in the VAT Act, of an e-invoice, an e-credit note, an e-debit note, something called an interoperability framework, which is how people can exchange information with each other and with SARS. And then where SARS comes into the picture, e-reporting, which then draws on all of that electronic information flow that's happening. So in line with the discussion paper we've already released, and another one that is going to be coming out fairly shortly, we're proposing to start building the pillars for the VAT modernization project. And that's what these proposals do. I think a key point to bear in mind here is that this is currently all voluntary because we all need to learn. And so there's a degree of flexibility built into these definitions, but then equally it is a voluntary set of provisions that we will use with other interested taxpayers to start building the system. As we learn, we can then develop it further. Moving on. Last year, we modified, Treasury and the Minister, I should say, modified the rules for foreign suppliers making supplies of electronic services into South Africa. Previously, those rules applied whether the foreign business or foreign supplier made supplies only to consumers and businesses, or only to businesses. Now, where a supply is only made to a business, there's what's known as the domestic reverse charge, which comes into operation. And in any event, most of those local businesses will then claim the input tax once again in their VAT calculation. So if it's a pure business-to-business transaction, the risks are substantially lower than if it is a mixed business-to-consumer or business-to-consumer only set of transactions. So the regulations last year said, if it's pure business-to-business, you can come out of the regulations. You do not have to charge VAT. As the foreign supplier, you can rely on the domestic reverse charge by the local party. Now, that means that there are some foreign suppliers who are no longer required to be registered for VAT. And so they may well end up with refunds. And since they didn't have to have a bank account in South Africa at the time, they just could make refunds from overseas, payments from overseas. Now we currently have a system in our legislation that says you should have a bank account in South Africa. But it's difficult to open a bank account in South Africa if you're purely foreign. So we do open up an ability to make a refund where you now do register because of the change in the regulations. So moving on to the next slide. So VAT. Now, when someone registers for VAT, SARS needs to check that they are a real business, so to speak. Because there are unfortunately a number of fraudsters out there who will create fictitious businesses in the hopes of being able to claim fictitious VAT refunds. And as one of its risk mitigation strategies, SARS sometimes visits the premises to see, is this consistent with what has been given to us? Sometimes the address may not exist. Sometimes the address may be a residential home when someone's claiming it's a factory. Whatever the case may be, it is useful to be able to inspect the premises. And so the proposal here is to permit SARS to inspect business premises on a registration request. And as noted there, we do also have risks around employment tax incentives and tax privilege status. So the proposal then is to allow SARS to do the inspection. As is noted there, because sometimes you do have home businesses, where there is such an inspection, it would then only be for the portion of the home that is used for business. SARS would not inspect the remainder. Moving on. Suspension of debt. So currently, if you intend to dispute an assessment, you can get a suspension of debt. There's the pay now, argue later principle, but equally there are a set of factors that if you explain yourself to SARS, you can get a suspension of having to pay the tax that is due. Now, with the innovation of auto-assessment, you can be auto-assessed, and if you want to put in a revised return because you disagree with the auto-assessment, you're perfectly entitled to do that. But it may be that it takes a while before that particular return is finally revised. You get a decision from SARS that they are not going to revise it. Now, the question then is, well, can you get a suspension of debt under those circumstances? And practically speaking, SARS has been granting such suspensions. But the question has been that it would be more helpful if the legislation was clearer in that regard. So this proposal responds to that request and specifically builds in the ability to request suspension of debt where there has been an assessment based on an estimate. Moving on to the next slide. This proposal is intended to clarify an issue that has become somewhat contentious, and I expect this will be an area where there will be a fair degree of comment that the committee and SARS will receive. And this is around the concept of a bona fide inadvertent error, which gets you out of the understatement penalty system. Now, this exception did not exist in the original Tax Administration Act as introduced and promulgated. But what happened was, and I'm just going to ask to skip forward to the next slide briefly. Thank you. Was this. There are a number of behaviors set out in the understatement penalty system, and then there's one objective test, which is the substantial understatement test, which triggers as soon as there's a prejudice to SARS or the fiscus of the greater of 5% of tax or 1 million rand. So what happened was, if you go back more than a decade now, SARS's systems were not quite as sophisticated as they are now. And so people had to enter things like their retirement annuity contributions manually. And so let's take the example with someone with a retirement annuity contribution of 36,000 Rand. Now, that is a Rand amount, and the return asks for a Rand field. But what the person did, being perhaps the first time they filed an income tax return, perhaps they make an error because they're up against a deadline, the facts would vary, but they put the cents in there. So that deduction now goes from 36,000 Rand to 3.6 million Rand. And you can now immediately see the problem. That is substantially more than the 1 million Rand we're talking about there. And so SARS had no way of undoing that, because this is an objective test. We could agree that the taxpayer took reasonable care, that they weren't trying to engage in tax evasion, that this was really an honest error. But now the penalty sticks. And so the exception was created. But the exception was created as an exception for all of the understatement penalties. And so there has been intense debate as to what that then means and what the impact is. Now, we were hoping for the Constitutional Court to give us clarity on that, but for factual reasons in the particular case, the Constitutional Court declined to do that and left the question open. So the proposal now is to explicitly link the two so that whilst there may then still be some disagreement about what a bona fide inadvertent error is, its scope is very much clearer. Now, if we can move on to the next slide. So what I should point out here is that that doesn't change the system, because if you're not engaging in unacceptable behavior, you still should not be subject to an understatement penalty. So if you took reasonable care in completing your tax return, that ground wouldn't apply, and so on for all the other grounds for imposing an understatement penalty. And then the last bullet is also a very important one, is there's no proposal to change the fact that the onus is on SARS to prove the facts upon which it based the understatement penalty. So I expect that there will be, as I say, a fair amount of comment around this one, but it is indeed a very targeted intervention to try and restrict the scope of the disagreement that has arisen and which unfortunately is still open around precisely how you should interpret these terms. I think that's it from my side, and I thank you, and I'll hand you over back to Nhlanhla and Chris.
Thank you, Franz. Chris?
Yeah, thanks very much. Maybe I'll come in there just with a couple of concluding remarks. So there were just a couple of issues that I did want to raise for the members. So the one thing that is quite unique this year is our withdrawal of the proposal on the preference shares. Now, this is not something that we do often. We really try to avoid that. But for this proposal especially, we did get a lot of comments that said it was impacting on investments that were trying to take place as we speak. And if we had waited and gone through this whole process, those investments would have been delayed. And that is not what we were trying to do. We could have waited to do the comments to then try and put forward a revised version. But we thought it was better in this environment to withdraw the proposal and then have further discussions on it going forward, which is why we then released a media statement to withdraw just that section on the preference shares. On another couple of issues, for example, the foreign pensions proposal, there's been quite a bit of concern that we are trying to double tax individuals. And just to reiterate our rationale that Zalisile put forward was for foreign pensions, if you are receiving a pension from a foreign retirement fund, but you are now a tax resident in South Africa, according to our double tax agreements, which we've agreed with other countries, we actually have the taxing rights on that pension. But in our domestic legislation, it is exempt. So that foreign pension that is being paid to a tax resident here is being taxed in another country. If that pension is being paid, for example, from the UK or from Germany, HMRC in the UK is taxing that pension and they are getting the revenue. In Germany, the Revenue Authority is getting the revenue, but we actually have the right. So the proposal here is to say that we would like to tax it in line with our double tax agreements with those countries, and then those countries will stop taxing it. So it'll be a transfer. So it's not as if those pensions are going to be double taxed, because the amount should not be taxed in the other country anymore after we start taxing it. There might be edge cases where, for example, there weren't deductions on the contributions into those funds, and those we need to sort out. The principle and the policy principle is that we're not trying to double tax, but we are trying to enforce our taxing rights, which would get revenue for us, according to our rights. The other one is on the VAT on educational services. Now, I think there has been a little bit of confusion about what we're trying to do here. So there were discussions between National Treasury, SARS, and the associations of schools where they were looking to try to simplify the process. Schools aren't good at doing VAT returns. They don't want to do VAT returns. They don't have a lot of tax accountants or others to do those returns if they were then pushed above the 1 million. Now, this is only for services that schools provide that are not educational services. So it's tuck shops, it's renting out their boarding facilities or their fields. And if the revenue they get for those types of activities goes above 1 million, they're supposed to register for VAT. This was to try and reduce the admin burden for schools, to say that everything will be free from VAT. I think there is confusion about the deemed supply and how much will then be paid back to SARS. So as Umpol was saying, this is about recouping the input tax that was claimed. So for example, if a school was claiming an input tax on a new AstroTurf that they put in, the portion of the AstroTurf that is likely to be used to be rented out, for that amount, they would be allowed an input tax or potentially a VAT refund on that amount. If they are now deregistered, in effect, the government should recoup that amount. We're not trying to say that the full VAT on the full value of all infrastructure should then be paid to Treasury and SARS. And I think there's a little bit of a misunderstanding between us on that issue, so that the schools are saying there will be these huge liabilities because that full value of the deemed supply will then be liable to Treasury and SARS. But as Umpol was saying, it's just about the input tax that they've paid, and we will have discussions with them on that to try and clarify. But obviously, we're happy to take any other questions. Thanks very much, Honourable Chair, Honourable Members. Apologies, it is a lot to take in. Thank you.
Honorable Chairperson, are you still there?
Okay. Yes, Honorable Van Ryan, I was having some challenges with the technology. Yeah. There we are, honorable members. Is it me who have got a problem with the technology? Butla, Alan, can you hear me?
Yes, we can hear you, Chairperson.
And can you hear Honorable Van Ryan?
Yes, I could hear him as well.
Is he speaking?
Not at the moment.
Honorable Van Ryan? Yeah, we could not be able to hear you. So there was a problem with your connectivity. You can start again.
No, Chair. I was just trying because there was a lull after the presentation of National Treasury. So I was just trying to check if you are still on the platform, because remember, we'll do whatever from now based on your directive as the chairperson of the meeting.
Okay, Honorable Van Ryan. If there are clarity seeking questions, honorable members can ask those clarity seeking questions. As it has been alluded to at the beginning that there are legislations that have not yet been tabled, so we can't go deep into discussions with legislations that haven't been tabled because we don't want to preempt the discussions or the engagement that National Treasury will have even with the stakeholders and at the cabinet level. Preferably, we discuss or engage in discussions on the legislations that the minister has tabled through the speaker, and the speaker refers such a legislation to the committee. That's the procedure that we prefer. You'll remember last time we had an issue with the Public Procurement Act when National Treasury came to us before the act could be tabled. Members were not happy with that kind of an arrangement. Be that as it may, let's engage with the discussion that we have received right now. Should I come back to you, Honorable Van Rooyen, or you come after before I take Beasley and Bateman?
No, I raise my hand, Chair. That will be determined by yourself.
Yeah, over to you. Then I'll come to Honorable Beasley and then Honorable Bateman.
All right. Thank you very much, Chair. But also, let me pass my greeting to all in attendance, members of Parliament, and the team from National Treasury and SARS, and welcome the presentation made. Just some few clarity-seeking questions. On the tax rate bill, of course, public participation is still going to be made. But I'm not sure because, Chair, if you remember well, during our induction as the 7th Parliament, it was brought to our attention that the Constitutional Court ruled quite extensively on the failure of Parliament processes to be enhancing public participation. But also, if you look into the recent presented annual performance plan of Parliament, emphasis is made on enhanced public participation processes within the Parliament system. Now, of course, that enjoins us as members of various parliamentary committees to hold departments accountable on their public participation models, because in the main those are models that fit into the parliamentary process, but also into the processes of lawmaking in our country. So I'm not sure if National Treasury can confirm if the envisaged public participation model, because it seems as if still the status quo, where sectors or maybe captains of industry are engaged as the main contributors to such legislations. And this is despite the fact that these legislations got an effect, either positive or negative, to the majority of our people. Now, I'm not sure to what extent does this public participation model that the Treasury is going to engage in responding to this particular reality that we are faced with as a seventh parliament. Because the Constitutional Court has made a clear indication that we are not doing well in terms of public participation. And listening to the presentation, it's easy for me to conclude that it's a status quo approach to public participation. But I'll hear from National Treasury if they're intending to do their public participation differently this time around, or are they retaining the status quo model that promote participation of sectors and, of course, industries at the expense of the broader masses of our country. Secondly, Chair, I just wanted to check because in their presentation, more especially on the inner city urban aspect, that area of Section 13 of the income tax, they are referring to engaging various stakeholders. I didn't hear them speaking of SALGA as an association that is representing municipalities that will be mainly affected by this particular muted amendments. How is the working relationship between National Treasury and SALGA on this particular aspect? And thirdly, the review that is being extended by 5 years on this incentive, a tax incentive scheme. What happened to the previous, because we haven't received any report, Chair, if there is any report. What happened to the previous determined period to undertake this review? Why is now extended for 5 years? I'm saying this because, Chair, in our discussion as COF, we have made it very clear that some of these incentive schemes need to be reviewed, and we were waiting for obviously feedback on this review process, more especially on their impact, because we have realized that we are losing a lot of money as a national fiscus on these tax incentive schemes that are not yielding results, more especially those that are meant to create employment, because as we are all aware, there is little, if no impact that these schemes are making in terms of obviously creating jobs in areas where they are meant to do such. In fact, in some cases, as we are all aware now, factories are even closing. And these are factories that have been benefiting to some of these tax incentive schemes. Now we are listening to another 5 years extension of this review. What happened to the initial review? Why an extension of another 5 years? While we are quite aware that, or maybe it's apparent that some of these incentive schemes are not impacting as expected. And as a result, they are charging a lot of money. Here we are referring to substantial amounts. I think last time when we had a presentation from the budget office, these amounts were ranging into billions. And these are billions that we daily need, to take care of other priorities of the government. Then, thirdly, Chair, maybe on the TILAC, just to check, Chair, because, I appreciate the provision that is being made on child maintenance, or the principle that they are employing on child maintenance taxation, because it makes sure that the legislation enables the said provision to serve its purpose, which is here to promote, the maintenance of the child. So I just wanted to check, because I know this is the same principle that we have been advocating, arguing for, more especially in the military veteran sector. Why is it difficult for the same principle to be employed in the pension, military veterans pension payment regime? I'm saying this because this principle is not applied there, and the regime is introduced, or provisions of this regime are introduced in the main to make sure that military veterans, whatever that they get, is meant to improve their life. But the same money that we take from the fiscus, to empower military veterans or to improve their living conditions, is taxed. So why the same principle? I just wanted to check on National Treasury or SARS take on this. Why the same principle that is employed on child maintenance, which is a very good principle, is not employed in the military veterans pension payment regime? I think it will go a long way to make sure that their living conditions of the living condition of military veterans and their dependents is improved. Well, Chair, I know you said we shouldn't go into details, but I felt very interested when it was emphasized that there is a point where, what is this? Those who are contributing to charities, or maybe those that are contributing to a public interest organization, they should be, their taxation should be calculated, or maybe their claims should be calculated to a 10% threshold. But the presenter wasn't clear to me when he said that point, that the 10% provision will be determined at a certain point. So I'm not sure which point was he referring to. But maybe the details, as you have said, Chair, might be in the legislation that still need to be tabled. But if there's clarity on that matter, I think that will help a lot. On VAT, I just wanted to check if there's any impact, because apparently the provision that is made, the zero rating provision that is being made on gold will be made on silver. I just wanted to check what might be the impact of this zero rating to the envisaged tax revenue. If there's any impact, is it a positive or a negative impact? And one other issue, Chair, is this thing of vouchers for telecommunication service providers. I'm not sure, because I know last time we were told that there might be a challenge on the enforcement capacity of our tax authority. I'm not sure what is the enforcement capacity of this, because it appears to be, from where I'm seated, an administration nightmare. How is it going to be enforced? So as we are able then to marry this provision to its feasibility. how is it going to be enforced, this issue of vouchers, that the presenter alluded to. And lastly, on the Tax Administration Laws Bill, the presenter indicated that there won't be any need for auditors to provide certificates, but they will allow independent persons to do that. Maybe the details are also in the legislations, because when you say you allow independent persons, obviously there should be a criteria that they must meet, because anyone can be independent if that area is not defined. As much as auditors are somehow expensive to most of the service providers, but let's get to know what's the criteria, because the current bills, the current presentation doesn't talk to what will this independent person be required to qualify, or maybe the criteria that he or she must meet for that particular person, to qualify to give the certificate or an opinion on the status of a service provider. Thank you very much. I think, as you have indicated, some of the themes, especially on the carbon tax regime, is a very extensive regime. There might be some inputs going forward from our side. Thank you very much.
Thank you, Honorable Van Rooyen. Honorable Beasley.
Thank you, Chair, and thanks to National Treasury for their presentation, to Chris and his team. So the first question is just a generic question. How does National Treasury keep up to date with these amendments? Can somebody from the public send in an email? Because often I get messages from people saying they're confused, this needs to change. How can the public actually engage with National Treasury and SARS on possible amendments to actually improve the tax administration? And then in terms of, this is more specific questions, the excise duties, I'd like to get National Treasury's thoughts about the logic about increasing excise duties above inflation for alcohol, because we're just creating a massive own goal for ourselves, because we're just allowing the illicit trade to so we're actually going to be losing more in the long term. We're losing out on excise duties, we're losing out on VAT, we're losing out on pay as you earn, we're losing out on normal tax, because we're allowing the illicit. So I'd just like to get National Treasury logic behind it, and do they actually think that they're going to be collecting more tax by doing this? Because to me, we're just scoring a massive own goal. And then just to touch on what Honourable Van Rooyen said, the urban development zone incentive, how much is it actually costing the fiscus, and have we done a proper assessment? And that ties in with employees and tax incentive. I've just heard, from the market that this is just a free handout. It's not benefiting anybody. I think it's costing the fiscus over, I think it's 7 billion rand a year. So I think we really need to look at these incentives and find out whether they're actually benefiting. Then just on the ring fencing of assessed loss, we're putting it at 39%. Why 39% is just, I'd be interested why we landed at 39%. And then the diesel refund system, how do we know that it's not being abused? Because I think that's a big concern. People are getting rebates for diesel, and then it's actually getting into vehicles that are actually driving on the roads and actually impacting on legal business again. And then in terms of customs duty, something that I really think National Treasury and SARS needs to look at in terms of e-commerce. E-commerce is starting to find, Chinese e-commerce specifically it's getting its foothold in South Africa's business. And I think National Treasury, SARS, we need to do more to protect local businesses. And the big concern is that people are undeclaring their imports, and then they're getting paid offshore. So somebody's importing, say, for 5 Rand, they're selling it for 50 Rand, and they're settling the bills overseas. So local businesses are on the back foot. And what is National Treasury and SARS doing doing in this regard. And then in terms of that, the modernization, I think it's excellent. And just to find out from National Treasury and SARS if they're learning from best practices around the world, because I'm sure there's countries that are several steps ahead of us, and are they actually learning, in terms of the modernization from other countries, so we actually don't have to pay the school fees. And I think in terms of visiting premises for VAT registration, I think it's an excellent idea, but I don't think it should only be on VAT registration. I think it should be an ongoing thing, specifically when there's quite a few VAT refunds coming, and do they do that? And then lastly, the VAT on the educational, I think it's going to be very confusing for the educational guys how to reconcile. And I'm sure a practice note will be coming out, or how will they actually assist the educational institutions with this matter? Thank you, Chair.
Thank you, Honorable Bisley. Honorable Bateman.
Thanks very much, Honourable Chair. Good morning, honourable members. Thank you and welcome to the Treasury. Enjoyed your presentation. Just a few questions from my side. On the VAT on the schools, do we know how many schools this will affect, and how much output tax has been received in each of the last 5 years that obviously will no longer be received, and also how much input tax has been claimed each year for each of the last 5 years? And how much output tax will be payable in terms of the deemed supply rule on deregistration if this law change is implemented? And has Treasury modelled the effect that this change will have on the school fees paid by parents in the year following the implementation of the law? And then on the foreign pensions change, how much additional revenue are we projecting to raise? Do we know how many taxpayers will face double taxation without double tax treaty relief? And have we modelled, and what are the economic consequences of the measure, e.g. its effect on immigration and any other tax streams? And then on the capital distributions by collective investment schemes, I understand that there was a concern at one stage that there'll be situations where taxpayers are taxed on technical gains within a collective investment scheme, which haven't actually been paid out to taxpayers. Is this still a possibility, or has that possibility now been removed? If you could just comment on that. And then on Section 42 and Section 44, excluding collective investment schemes, I understand the abuse and the change that's being proposed to address it. Is there a risk that the proposed change may be too broad, with the effect that legitimate transactions involving two collective investment schemes are caught up in the exclusion when they shouldn't be? For example, if one collective investment scheme is amalgamated into another, will this now trigger capital gains tax? And if so, is this an intended consequence, or is this an unintended consequence? And are there any other possible unintended consequences from the way the exclusion is being drafted? That's it. Thanks.
Thank you, Honorable Bateman. National Treasury and SARS, can you please respond to those clarity-seeking questions from honorable members?
Thank you, Honourable Chair. I'll have a go and then ask my team to come in on some of the issues as well. On the public participation process, we are trying to adjust the public participation process given the events at the beginning of this year. For the first time, we held a fiscal policy workshop on the 22nd of August with NGOs, with Labour, with everyone else. The Minister did attend. It was also shown on YouTube, where we had a very open discussion about our fiscal policy issues and what we need to consider. So we are trying to increase our public participation as much as we can. It's a work in progress, and we will continue to do it. We'll get some feedback on that workshop from stakeholders to see what they thought. But those interactions then have helped us with putting together the medium-term budget policy statement, and we do have their views. On the incentives, Warren can come in on the different incentives that we have evaluated. since the Davis Tax Committee have come in, we do evaluate incentives. We've done a host of a long list of evaluations. For example, the learnership tax incentive. We have evaluated the employment tax incentive before, and we've taken those incentives, for example, to NEDLAC. Some of the incentives we've evaluated and we've removed. So there used to be a 12J venture capital incentive, which looked as if it was just being, the majority of it was being used for as a way to reduce tax liabilities rather than achieving the objective of the incentive. So we removed that incentive. The urban development zone incentive, Warren can come in on the details, but we just didn't get enough of the responses from all the municipalities. At the moment, it's costing 152 million per year, but some of the municipalities that did get back to us said it was a very useful incentive, and it was they would prefer that it was kept, which is why it was extended. On the child maintenance is quite different to the military veterans issue because child maintenance payments, the tax has already been paid. So if somebody receives income, they get taxed, then they do a payment to their ex-spouse for child maintenance, but it's already been taxed in the hands of the person who is making the child maintenance payment. Whereas military veterans, that amount hasn't been taxed before. So it is quite different, and we would view it quite differently. On the zero rating on silver, it is similar to gold. There isn't theoretically supposed to be a difference in tax revenue, but it is a mechanism to reduce fraud in the system. So if it does reduce fraud in the system, then hopefully it will increase tax revenues from that perspective. But if there wasn't any fraud before, then it shouldn't make any difference because the VAT on that would have been paid. I'll ask for maybe Umpo to come in on or SARS to come in on the enforcement issue with vouchers. How does Treasury keep up to date? So each year at around November time, we issue a media statement where we ask for calls from the public, where they can put in any of their proposals in terms of where they think the tax system is not up to date, or there are loopholes, or there's a new type of economic activity which isn't catered for correctly in the tax system. We get a lot of those proposals in November, and then either at the end of November or December, we have a workshop with everybody who commented on that. Anybody who comments can then come to that workshop and discuss. We then review all of those comments, and that's what feeds into Annexure C of the budget review every year. We will go away and discuss with SARS and others about whether the proposals that are put forward by the taxpayers are worthwhile, and then they can be put into Annexure C. At any other point, policy amendments can also be emailed to us, where we can think about a changing tax policy through the year, and then we go through those. The excise duties for alcohol, for this year, it was about raising revenue. We needed to raise revenue by some manner and some means this year in the budget to stabilize our debt as well as fund social expenditure. Alcohol excise duties was one where we thought, and the minister agreed, could be used to raise some additional revenue. We definitely understand the points about illicit trade, and there needs to be a balance there. Enforcement needs to be strong, it needs to be correct in order to reduce that illicit trade. But also from a National Treasury perspective, we want the price to go up. We don't want excessive alcohol usage in our society. And part of that excise duty is to try and reduce consumption. If we reduce consumption, that isn't a bad thing. We don't, and if the revenue goes down from excise duties on alcohol, again, that's not a bad thing. There are many studies which show that the indirect costs of excessive alcohol use are very large. However, if it leads to increasing illicit trade, where that consumption takes place anyway, that is a bad thing. So we do try and recognize that balance, and we try and make sure that we don't go too far one way or the other. I mentioned the UDZ costs 152 million, the employment tax incentive costs about 4.7 billion. There were a lot of studies done on evaluating the employment tax incentive. The problem was at the end of them, some studies said it did have a positive impact, some studies said it didn't have a positive impact. The last one said we can't actually tell whether it's had a positive impact or not. it is our only mechanism within the tax system that is used to try and increase youth unemployment and reduce youth unemployment. A lot of our incentives in the tax system are there to reduce the cost of capital, which actually shifts business expenditure away from employment to capital. So it would be quite difficult to take it away, in my view, because it is the only mechanism we're using where we have such high youth unemployment. But again, that incentive was extended with the permission of this committee as well as through NEDLAC all the way up to 2030. But we will continue reviewing it. Maybe I can ask Nhlanhla to come in on the 39% for ring fencing. The diesel refund, there can be abuse of the diesel refund, but part of that is from import-exports where, for example, amounts are intended to be exported and they don't pay the duties, but they come back into the country. And that really is also, again, an enforcement issue, which SARS are working on, and they have made some very good gains in that in the past. The other is using IP, illuminating paraffin, within diesel. And again, I think we do need to do a bit more work there, but there is an IP tracer dye levy to try and stop that. This amendment is it's for agricultural workers. It's aligning with the original policy intent. It should also help with reducing food inflation, because of those agricultural activities that will now be able to have a greater diesel refund. They have a lot of logbooks that they need to then share with SARS, and SARS can come in if they would like to make sure that the abuse doesn't happen. But SARS do audit those activities. E-commerce, to protect local businesses, I think the points are noted there. That's also why we've had this amendment this year of the low value, high volume imports, which are going to be included in the net so that we have a level playing field across different e-commerce providers, whether they are foreign or domestic. And the VAT on educational service, we're going to have those discussions with the school associations and make sure that we're all on the same page and everybody is understanding that exact problem. We can ask SARS, we don't have the figures on the input tax and output tax that's payable exactly by those educational institutions over the last 5 years. We'll ask SARS if they can assist with that amount as well. On foreign pensions, there is a source code that we did look at to try and see the total value, but I'm not sure it includes the exact pensions that we are looking at. So we need to do a little bit more work on finding out exactly how many taxpayers that would impact, as well as the value. From a theoretical point of view, it makes a lot of sense to us, but we will look at the figures on that. Maybe I can ask Nhlanhla to come in on CIS and 42, 44. So I think that's Warren on incentives, Umpo on the vouchers, Nhlanhla on 39, CIS and 42, and then SARS can come in on the others. Thanks.
Yeah. All right. No, thank you, Chris. Let me just go on that 39%. I think the key issue as well was the fact that we believe that, the high income people are the one who are actually conducting these suspect trades. You won't in any case find a person who's earning at the lower bracket coming up and conducting some of these suspect trades. And that's where we're coming from, and that's where the threshold came from. And then on the other CIS's one, I think you're quite correct, Honorable Bateman, that yes, there might be some issue. We're actually going to look into the wording as well as to see if maybe we haven't actually gone too far. One of the key issues that came up, I think, just at the glance of some of the comments that came in, was the fact that maybe we must look into some definition and say we are focusing on closely held CIS, even though I don't know if we'll be able to get to that definition, but I think that's where we're at. Yeah, I think those were the key ones. I think there's also another comment as well on that front to say, given the fact that some of the structures, in as much as we're trying to cater for the current structures not to be impacted now, but then the question is maybe some who might have got the ruling or some, in the past, what do you do about that? But I think all of that we're going to discuss it as well in the workshop in the coming weeks. Thank you so much.
Yeah. Good morning, honorable members. Chris has asked me just to touch on a little bit about our incentives management framework. So in relation to the UDZ as specifically, as Chris had mentioned, it's been in the system for a long time, but in terms of revenue forgone, which we present annually in the budget review documentation in Annexure B, it's not as expensive or as costly in terms of revenue forgone relative to other incentives such as the employment tax incentive. In 2019, it cost about 267 million in terms of revenue forgone. And then in the latest years, 164 million and just over 70 million in the 2022-23 year. So we try to monitor these by keeping track of the costs which we publish annually in Annex B. And then in terms of the UDZ incentive itself, we were aiming to do a much more holistic impact evaluation. However, as Chris had mentioned, we needed some more information related to reporting from municipalities, and that was the reason why we extended the incentive for another 5 years, and also to provide just some certainty for the market in terms of projects that are committed, given the provisions of the incentive. Overall, in terms of the incentive management, we are working in improving the entire system across the ecosystem of business incentives management in South Africa. So looking at incentives provided through the tax system, but then also non-financial incentives that would be provided by different spheres of government at provincial and municipal level. The Department of Policy Monitoring and Evaluation had commissioned a study on the system of incentives in 2018. Out of that study, certain recommendations were mandated to the National Treasury. Part of this was to develop a framework around incentives so that we can manage, how these incentives are motivated and how they are monitored and evaluated. The Treasury is busy with work in this regard, so that we can have a much more aligned approach on incentives and effectively monitor and evaluate the effectiveness over time. So that project is ongoing and part of the annual work of the National Treasury. Thank you, Chair.
Treasury and SARS, are you done with the clarifications?
Maybe SARS can come in. Thanks, Honourable Chair.
Great. Thank you, Honourable Chair. Just some responses from my side. On the question of PBOs, so there are two sets of percentages involved here. The one would be what percentage of the activities relate to deductible donations and what percentage don't. So that's the one. The other raised by the Honourable Member was around the 10% cap. So this is a cap that is applied to the person who makes the donation, and it is applied at the end of the year in the assessment. So if you have a taxable income of R1 million, the maximum you can deduct it by way of donations is 100,000 Rand. If by chance you've made 150,000 Rands worth of donations, the additional 50,000 rolls over to the next year where it may qualify for a deduction, again subject to the 10% cap. There was a question around the independence and the qualifications of the person. So this is a difficult one. I mean, independence, we can always go and look at the dictionary definition. I think that's the easy one. The question of qualification is perhaps a little bit more difficult. And clearly one of the things SARS could consider is that when you provide such a certificate, you need to indicate what your qualification is to issue it. And then SARS is in a position to determine how much reliance to place on the certificate. I suspect large PBOs that are already being audited because their donors expect them to be, would continue to do so and retain the services of the auditors to do that. Smaller PBOs would probably try and find someone who has accounting experience and would be able to assist them with that, but would either be willing to provide the service for no charge or at a relatively low charge compared to a full-on blown audit. There's a question around vouchers enforcement capacity. I think the enforcement capacity here comes around the question of taxation of the vouchers, rather than how much of the voucher purchase price or selling price should be subject to VAT. So I don't think the amendments change the enforcement challenge. They simply change what part of the amount being charged is subject to VAT or not. So I don't think the amendment changes the enforcement challenges. Diesel refund system, is it abused? Yes, it may well be. So you will note that if you go through the law reports, there are a number of cases where SARS has challenged taxpayers who have maintained inadequate records to justify the rebates that they are claiming and the refunds that they are claiming. The courts have been strict about being able to prove that you have used the diesel for the appropriate purposes that are covered by the rebates. And so SARS has a good deal of work that it does in the space. As Chris mentioned, probably your biggest area of abuse in diesel space is the adulteration of diesel with illuminating paraffin, where we do have a illuminating paraffin marker. You will have noticed from press reports that SARS has acted against certain facilities where equipment was in play which tries to wash out the marker to circumvent its detection by SARS further on in the supply chain. There was a question about the understatement of customs values. This is a challenge for customs administrations around the world. So SARS has a number of tools that it uses to try and detect such under-declarations. So as an example, we have cooperation agreements with other customs authorities so that we can try and get a sense of whether the export values that are in play match up to the import values that we see. We can use reference databases so that we can, from a risk point of view, say, well, this price just doesn't look like it matches up to the kind of price you would expect to see for these goods. So we do have a number of mechanisms which we employ to try and address the understatement of values. On the question of VAT modernization and are we following best practice? So this is still a relatively new field, but there are a number of, shall we call them, first movers that have moved here. And yes, we are examining how they did it and what lessons we can learn from them. Clearly, each country has its own dynamics, so you can't apply those lessons as is, but you can certainly try and tease out what the common success factors were that made it work for them. And hopefully, once you've got a reasonable sample size, you can come up with the success factors that should make ours work as well. Multiple refunds on the VAT system. Now, multiple refunds may not be an indicator of a difficulty. So as an example, if a vendor is an exporter, they will tend to generate refunds because they will claim back the input tax for the VAT that they have paid in purchasing the goods that, or manufacturing the goods that are then exported, and exports are zero rated. Now obviously fraudsters know this too. So SARS does have various risk rules where we try and pick up trends that we're not expecting, issues in the space, and intervene with them. And then it's not an inspection that is done, it is then more likely an audit or an investigation that is done to try and work out why it is that someone is getting a refund when we would not expect them to. So an inspection in this context is a rather limited thing. It doesn't delve into your records and so on. But if you go into the Tax Administration Act, you'll see then inspection is sort of your lowest level intervention. This is what it says it is. But when we get to an audit, that is when we start looking at records to try and tease out what the actual issues are. I think that covers the questions that I have. So thank you.
Thank you, Chair. We're done from our side.
Okay, thank you. There does not seem to be, follow-up questions. Okay, there's a follow-up question. Honorable Bateman.
Thanks very much, Chair. I just didn't catch the answer to the one question about there was a concern at one stage that there'll be situations where taxpayers are taxed on technical gains within the collective investment scheme, which haven't actually been paid out to taxpayers. And is that still a possibility, or is that possibility now been removed? Apologies if I missed that, but I don't recall hearing the answer to that question. Thanks.
Thank you, Honorable Bateman. Treasury, SARS, can you respond to that question from Honorable Bateman?
Thanks.
Okay. Okay, Chris, I think Honorable Bateman, I'm not quite sure if I follow it through, because there are two issues here. There's one where we had 3 proposals at the time, and then where we're saying, look, there will be a complete flow through that stems from the discussion paper that was discussed last year. And then there was the second part now that was, if you're talking about pure distributions, because what then has happened is that at the moment, I think if I can get the sense, which one are you talking about, the complete flow through with the CIS, or you're talking about that one that in relation to that part is that we're still working on it, because there were 3 key proposals of taking out the hedge funds and also to have the turnover rule. So on that one, we're still going to issue the response document there on that discussion paper. But with respect to some of the distributions that now they are not taxed, we have then come up at the moment, we issued it now, because the problem with the distribution is because as a unit holder, I can only be taxed when I'm selling the unit. But then any other distribution that the fund itself now distributes to me, we're not taxable at the moment because it was just a distribution. But so at that moment in time, so what we then said at the moment is to say, look, any other distribution that will come out will then be taxed. So we still have that engagement now, and I saw some of the comments as well a bit. Some they were saying, look, maybe at the moment instead of taxing the distribution itself, maybe rather reduce the base cost to say, because you bought this unit at 100 back then, and now it's at 100 and whatever the amount, then reduce that base cost, because some of these funds are able to track that. But we were trying to do it otherwise, to say, look, any distribution, we tax it under the CGT, because we thought that we're trying to eliminate the compliance burden, because there was an issue that came up from the discussion paper to say, look, there will be a compliance issue for any other funds now to track each and every person who holds this unit. They don't have the capacity to do that. So I think if you're talking purely on that distribution, yes, it is in this current draft TLAB. We're still going to engage again some of the taxpayers come next week as to whether we really need to go back and reduce the base cost, or should we deem that distribution to be should be taxable under the CGT. So there is that part. But if you're talking about the other ones, the other issue, the 3 key proposals on the CIS paper at the time, the complete flow through, and the other 2 other proposals on the turnover and the exclusion of the hedge fund, that one we pulled it. There was no amendment that was made in the current TLAB, and we're going to issue some sort of a response document to give the way forward on those proposals. Thanks.
Okay, there we are, honorable members. We will further process the bills, those that have not yet been tabled, as and when the minister tables them and the speaker refers them to the committee. The sooner that they are tabled, the better, because we've got a very tight schedule as a committee. We don't only deal with bills, because the Standing Committee on Finance also has got a responsibility, like portfolio committees, to deal with issues of department and entities. So our workload is quite much bigger than even those of portfolio committees. So work with the minister to process those bills and they be tabled. The issue of above inflation taxation on the liquor industry, let's discuss it further, because last time it was raised very, very, very sharply, and we can't ignore it. So let's find a way of discussing it either during MTBPS or when you table these bills, so that we go deeper into what we are dealing with here, because that industry has raised very, very serious questions, which as parliamentarians we cannot ignore because we are not technocrats, we are public representatives. The same applies with the tax on schools. It should not only be the Association of Schools. DBE should be constructively engaged on this matter, because schools is their competency. Thanks very much, honorable members, National Treasury, SARS, officials from Parliament who are support team to this committee, and stakeholders. The meeting is adjourned. We are meeting again this evening, Alan Tebuko, to process the spread plan and the APP, isn't it?
Yes, Chair, that's 6:30 after plenary this evening. I sent the link a bit earlier on, and I also sent the Stratton APP sometime yesterday. Thanks, Chair.
Okay. Okay. Let's adjourn the meeting. We'll meet again in the evening.